Welcome to Global Investment Insights, our weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Turn of the calendar quarters are important for investors. Not in the sense that the flip of the calendar from June to July would materially change the outlook abruptly, but in the sense that change in the calendar months give opportunities to take a stock of the market performances and assess the outlook. So on today's podcast, let's deal with this in two distinct parts. First, reviewing H1 2022, and second, previewing H2 2022. First, looking back at the first half of the year, it has been dismal to say the least. Driving the turbulence in financial markets were a range of factors including persistently high inflation, slowing growth, lingering virus, rising geopolitical risk, and the central bank tightening all at the same time. What was more stressful to investors was the fact that bonds and equities experienced volatility and drawdowns simultaneously. Global equities entered a bear market while global bonds recorded their worst performance ever. As we have noted several times on this podcast and in our publications, financial markets are notoriously famous for their inability to focus on more than one risk at a time. Therefore, when confounded by a range of risks, financial markets tend to become more volatile, purely reflecting the uncertainty. During such periods, the bearish sentiment dominates, and it is easy to be bearish at a time when asset prices are falling. This further exacerbates the weakness in financial markets. This has been the story so far this year. However, the narrative driving market performances seems to have changed more recently. While markets were fixated on the persistent and elevated inflation for most part of the first half of 2022, recent weeks saw more focus on rising recession risks. No wonder, recession is one of the most searched keywords on Google of late. Financial markets flip-flopped between good news is bad news and bad news is bad news regimes. Inflation surprises and growth disappointments were treated with negative market reaction. However, any good news on the economic growth front was read as being conducive for a hawkish Fed. Therefore, markets reacted negatively too. This has been the case for most of H1 2022, but more so for the second quarter of 2022. US stocks have recorded their worst first half in more than 50 years. Emerging market equities recorded their worst first half performance in 24 years. Overall, the MSCI All Country World Index recorded a loss of circa 8% during June, taking Q2 losses to circa 16% and H1 or the year-to-date losses to 20%. Amongst the other asset classes, the 10-year US Treasury yields reached a 11-year high on June 14th before falling sharply on growth concerns. Core yields in Europe followed suit as markets looked to price in a more hawkish ECB. 10-year BTP yields rose briefly above 4%, marking the highest level since early 2014, triggering an emergency meeting at the ECB. Credit spreads widened, with high yield spreads rising the most. On the FX side, the strength of the US dollar was the most dominant story. Amongst commodities, there was a broad-based weakness noticed during June. Industrial metal prices fell sharply in recent weeks. However, on a year-to-date basis, oil prices have risen circa 40%, although they pulled back sharply more recently. Going into the second half of the year, we continue to see macro uncertainty persist. While the recession probabilities have certainly risen, they're still not at levels which indicate an imminent recession as defined by the National Bureau of Economic Research. We're looking at the investment landscape through the lens of two broader macro scenarios. A mid-cycle slowdown is a more benign macro outcome and remains our base case as we think Fed tightening could play out like 1990s and not like 1980s. However, our worst case scenario considers the rise in recession probabilities. Worth noting that our base case scenario is now only marginally more likely than our worst case scenario. The month of July is important in setting the tone for the rest of this year. Second quarter corporate earnings, hotly anticipated US inflation data, and the Federal Reserve's monetary policy meeting are among potentially pivotal events this month. We will keep you informed on how things evolve. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com for more information. Stay tuned for more episodes where we discuss H2 outlook for individual asset classes. For now, this is Kishore Muktinutalapati signing off.